Hello everyone, thank you for taking time to watch my presentation. My name is Vaibhavi Vijay Kumbar and I am from Annasaheb Dhange College of Engineering and Technology Ashta from CSE IoT and CSBT department. Today I will discussing inventory control using LIFO method. This topic is essential because inventory management is a crucial aspect of any business impacting both financial statement and operations efficiency. In this presentation, I will cover the points like overview of LIFO method and how it works, the advantages and disadvantages using LIFO method for inventory control, practical applications and example of in various industries. Let's begin by looking at what the LIFO method is tells and how it functions in inventory control. What is the LIFO method? In inventory control, the inventory control is a crucial aspect of supply chain management, affecting the overall profitability and operational efficiency of a business. The last in first out method is one of the inventory valuation technique used to manage and control inventory. In the LIFO method, the most recently acquired items are the first to be used or sold, which can have significant implications for financial reporting and tax purposes. It is a method used to calculate the valuation of inventory. As per the underlying concept of LIFO, the latest item that get included in an inventory are the first to be sold at the beginning of an accounting year. In other words, while calculating the cost of products, people usually evaluate the cost of those products which have been recently added to the inventory and record the result as a cost of goods sold. While creating a balance sheet for your company, you can add the cost of newer products first and leave out old inventory cost on the balance sheet. Let's see how the LIFO method works. The LIFO method is particularly beneficial in times of rising prices as it matches higher recent cost against current revenues, providing a potential tax advantage by reducing a taxable income. However, it can also result in lower net income and more complex inventory management. It might quite difficult to understand the LIFO accounting method. Suppose a business purchased 100 grinders at a per unit price of rupees 10 nearly a year before. Then a week back, the business owner added another set of grinders to his inventory, priced at rupees 15 per unit. It's natural for business owner to want to sell off the second set as first. The LIFO accounting method enables him to do so. When it's time for the business owner to calculate the inventory for tax purposes, they can calculate the remaining stock at a lower amount with the help of LIFO. The main important reason behind this is the presence of disproportionately priced item in the inventory. As a result, the amount you have to pay as a taxes is far less. While LIFO has many benefits, one should be aware of its limitations as well. Misleading inventory data and incompatibility with international standards are the some of the limitations of LIFO method. Investors also find it difficult to comprehend this accounting method and also have lower reported profits, complex record keeping, potential for inventory liquidation, limited international acceptance, distorted inventory valuation, tax implications in deflationary periods, regulatory and compliance risk, impact on financial ratios. These are the limitations make the LIFO method is less attractive for many businesses, particularly those operating internationally or in industries where prices stability is common. Now see, when should the LIFO method be used? One can use the LIFO method in United States since its usage is permitted only there. This method is uncommon in India due to tax restrictions and implications. LIFO has mentioned about the good option if the cost of your inventory is expected to go up in the future. It is a good option if you reside the USA. If you undertake research about while companies use this method the most, you will find the gas, oil companies, car dealerships and retailers use it the most. Let's see the formula of LIFO method. If you wish to calculate COGS using LIFO method in inventory valuation, you have to find out the cost of your latest inventory. Next, you have to multiply it by amount of inventory you have sold. Let's see the method of examples. Here are few examples to understand the LIFO method better. Tina started a business which sold stationery items. However, it was not the best time to start a business because the cost of items required to manufacture the stationery items had risen. Tina can apply the LIFO accounting method to help her business go through these trying times. In other words, Tina should use the latest price paid for product while calculating. Here the calculation would be as follows. Number of goods into cost of each goods is equal to COGS, means cost of goods sold. Here the number of goods is equal to 20 into the cost of each good is 200 is equal to rupees 4000. Tina is well aware that the price of supplies may increase further, so she can calculate cost of goods sales with this lower number of get a tax break. Suppose Tina knows exactly how much the price will be increased in the next month. This lower amount will be help her bring down the taxes payable at that time. It will greatly increase the saving of Tina's business. However, it will be bring down its profits. LIFO concept is that a lot of inventory comes inside a warehouse in different time frames. So the inventory that comes last is issued first. Now we will know how to inventory valuation using LIFO method. This is an example of LIFO method to calculate hand on March 31. Using LIFO method, you do inventory valuation based on the inventory lying in the company's stores or warehouses. What is its value of 31st March? Now the data is given to us for this is that on 1st March the company purchased 600 units at the rate of rupees 5. Similarly, on March 5 the company purchased 200 units at rupees 5.10 per unit. Similarly, the rates for purchase made by the company on 9th March, 16th March, 20th March and 29th March are given here. So the format of store ledger is something like this. First of all, there is a date of column in it. Here we write the date of inventory purchased and the issue. After that, there is a particulars. Here the details of the inventory are written, that which inventory was purchased, which inventory is issued. It can be its bill ID or its transaction ID. Then there is a purchase type column. There is a column of issue and column of balance. There are three columns inside the column of purchase: unit rate, amount. These are three columns inside the column of issue. These are the columns, and there are the three columns inside the column of balance. Unit rate, amount means how much and what is amount of one unit in one purchase and what is the total amount. We have the format of the ledger in which date wise entries are made. Now we first make the entry in this ledger that on 1 March the company purchased 600 units at rate of rupees 5. In particulars, you can write the bill ID and the transaction ID, or here you can write the name of the inventory which was purchased by company. Further, within the unit, the rate of one unit of purchase of 600 units is rupees 5. 600 is multiplied by 5 and the answer is comes to 3000 rupees, which means inventory worth rupees 3000 was purchased. Now there is no inventory issued on 1st March. That's why its column has remained blank here. Now this inventory will come inside the balances because we do not have any opening inventory in this example. If you have opening inventory, then you can write opening inventory in this first line and the letter. The example which has been given to you. Now we go towards the second entry, where on March 5. The company purchased 200 units according to rupees 5.10, or the update will come on March 5. Another 200 units were purchased. The rate of 1 unit is 5 rupees 10 paise, or 200 multiplied by 5.10. Then answer is that inventory of rupees 1020. If you do not change the order here, then first inventory here is rupees 600. The first quantity of unit will come as is, and below we will add the inventory that has been purchased, that is at the rate of rupees 5.10 for the purchase of 200 units, and their total amount become rupees 1020. Now we come to the next entry. On 9th March, the warehouse has purchased 500 units. Now the issue will come to the production department in such a way that within this will implement the LIFO method, that the inventory which come last will be the first to issue. We'll go here. The date will be 9 March. The column of purchase is blank because inventory has been issued here. No purchase has been made. Now here in the column of issue we will enter how many units we have to issue. 500 units have to be issued, and let's issue 500 units. Happened we have to see whether the inventory which come last will be issued first, and this is the balance we have till now. Within this balance, inventory is going to come last. These 200 units are the ones that come last. If 600 units came earlier, then these 200 units will be issued first, and their rate is 5.10 rupees. The total amount is this is make 2020. We had to issue 500 units, whereas this will 200 units, which means that 300 more units have to be issued. Those 300 units which are previous inventory will be issued from this, because here will be implement the LIFO method, that is last in first out. So if this inventory is at last, then it will be first implemented. This is how the remaining dates will be calculated. Now let's see the advantages and disadvantages of LIFO method. Advantages are accurate valuation of current earnings, means the LIFO method is responsible for understanding profit and exaggerating cost of goods sold. LIFO method can help you to get a better measurement of a current earning of your business. Moreover, it helps to reduce inventory profit by aligning current business revenue with current costs. Second one is improve cash flow and offers tax benefits. When you use the LIFO method during inflation, your high cost purchases match with the revenues to make sure that business profits have not been overstated. It leads to reduction in cost of income tax and improve the cash flow of your business. Third one is well aligned with receiving process. There are cases when the LIFO method aligns perfectly with the inventory flow. Suppose the people responsible for inventory in a business toward them vertically in a business. Upon receiving them, the last inventory stock would always be the first to be used. Now see the disadvantages. Here are some disadvantages. First one is the incompatibility with international standards. The LIFO method valuation is not compatible with the guidelines of international financial reporting standards, so it is not accepted method under the taxation rules of many countries worldwide, including India. Higher taxes. When you use the LIFO method, if many exaggerate reported income for the particular period, which may increase the tax payable for the corresponding time frame. To sum up, inventory control using LIFO method can offer strategic advantages in specific economic environment, impacting both financial reporting and operational efficiency. The LIFO method of inventory control offers distinct advantages, particularly in tax savings and matching current cost with revenues. However, it also presents challenges including lower reported net income, increased complexity, and limited global applicability. Business must weigh these factors when choosing an inventory valuation method considering their specific financial strategies and regulatory environment. Thank you to all for your attention and for giving me opportunity to present this topic. Thank you once again.